is basically, I have called it maybe a slightly different theme, global macro trends in an uncertain world. So what I'm going to talk about is these trends, and then I'm going to link it into Europe, Northern Europe and Denmark. I think I will try to target to talk something like maybe 35 minutes, so we have ample time for questions at the end. I'm actually also happy to take questions as I talk, completely up to you, but at least try to keep your, if you have something on your mind, please also shoot at them at the end. So what I'm going to talk about is basically, so economics nowadays. So what I'm doing at the central bank is obviously looking at economy and financial system. I have a background from the private sector, financial sector. And what I'm going to talk about is these, what I will call macro trends, which is then impacting the economy. So hopefully what you get out from my talk is both what are the global things going out there, and how should we think about that in terms of growth, inflation, interest rate, and so forth. I'm not sure I'm going to answer all your questions, but hopefully you will find it, when I looked at the words coming up there before, inspiring and providing some insights. So the first thing I will talk a bit about is this persistent fundamental uncertainty. I will talk about this geoeconomic fragmentation. I will talk about high inflation. I will talk about weak private consumption, something I call global imbalances. And I will also come to AI. And I know an AI is a big theme for you. I will, of course, talk about it from an economic point of view, because an economic, I would say, economic financial point of view, because as it is for your business and your areas, it is a huge topic in economics, and it's in something which is quite difficult to get your grasp around. So my first thing I want to mention, and then I will try to conclude based on all these things at the end. So the first thing I want to talk about is this I will call persistent fundamental uncertainty. And what I mean with those two words is that I think it's persistent because we are getting shocks and shocks. So I have been an economist, of course, my whole career. I cannot remember that we have seen so often a new shock happening. And I'm also calling it fundamental because I think some of the things which are happening currently it's not some small things, it's quite broad. And I have listed here what I think they are. And I think that maybe AI is actually the biggest of them all, I would say, over the next couple of years. It's at least something economists are really scratching their heads to try to find out. How should we think about that? And I will come back to that later in my presentation. It will actually be towards the end of my presentation. I think climate change is certainly also obviously big. It's maybe, some would say it's very fast moving. Some would say it's slightly slower moving in terms of the impact on the economy and financial system than AI, but it's certainly there. I will not have time to talk about that. It's actually something we are also looking at quite a lot, but just in terms of priorities. What I will call the end of the rule-based world order, I think I will talk about that in terms of what I will call geoeconomic fragmentation and trade conflicts and stuff like that. So I will certainly come back to that. Wars, yes, I will talk about that because we have a war, or now we have a standstill, but we have some war going on in the Middle East, and that has natural, clear implications for economics and inflation and so forth. So I will talk a bit about that. Pandemics, I think, is not something I'm going to talk about, but it's something which are clearly with us. It's not that long time ago we had COVID, which was a huge economic shock, and we need to keep in mind, I'm not sure the world responded that well in terms of coordination, and given the more and more fragmentation we have in the world, can we really expect that we will react in a coherent way to such a shock? So these are the things which I think is creating this persistent fundamental uncertainty. As I say, I will have time to go into detail into some of them. So the first thing I want to talk about is geoeconomic fragmentation. And what do I mean by that? I basically mean that when geopolitics has implications for economics. So think of it that way, that you have policy decisions impacting what is going on economically. And the first slide I want to take to you here is basically try to think about now. So now I'm going to show you some numbers, but I think it's not the exact numbers which are so important. It's more that you get the broad trend and hopefully take that away from my presentation today. So if you look at this chart here, and I always have to think what is left and right for you, but if you look at the chart to the left, that basically shows you the number of trade, if you look at world import, how much of world import is basically facing some kind of restrictions. And what this chart to the left shows you is it's something like 20%. And it has risen tremendously. And if you look at it more carefully and you have at the x-axis the years, there has clearly been some kind of jump around the two Trump administration. You can also say it's also maybe linked to Brexit and other things. And then there's also something linked to 2022, which was obviously Russia's invasion of Ukraine. So these has clearly been some of the amplifiers of this trend. But it's quite, and that's what I mean when I say a more fragmented global trade. I mean, obviously, maybe the clearest example is that we, in big parts of the Western world, we trade a lot less with Russia, right? Russia trades more with India, with China. You have something you call Global South, where they trade a lot. You cannot see that in the Western part of the world, and you can see signs of some fragmentation given what Trump or the US administration did last year, but in general, you see still a lot of trade within blocks, what I would call blocks. So you can think of it as a Western bloc and a non-Western bloc. And there's actually still a lot of trade, but some fragmentation is going on. And what is on the right-hand side, seen from your side, is basically there's all matter of measures of geopolitical uncertainty. And this is basically trying to measure trade policy uncertainty. And that has skyrocketed. And maybe a surprising thing is that we have not seen the global economy falling apart more strongly than it has, including the US economy. I think many economists thought last year that this will be very bad for the US economy. But I think there's always contradicting forces in economics, and clearly the one which was pulling in the other direction was AI, right? Which was clearly creating a massive boost for the US. So how should we think about these trade wars? And that's what I'm going to go into and tell you a little bit more about if you look at the next slide here. And I will explain a bit because it's a little bit more detailed. So Trump did his trade wars against China. Remember that in 2018, where he basically targeted China very specifically. And then, of course, you had this Liberation Day last year, the US administration. And what I show you there in the chart to the left is the change in the Chinese export share to a certain country. And on the y-axis, you have US import from that country. So what is this chart going to explain? If you look at VN, that is Vietnam. So what is going on is that China is exporting, and this is changes since basically what happened last year, so pre-Liberation Day. So what is going on is that China exports now a lot to Vietnam, which then exports to China, right? So there is this a bit of rerouting going on, which is actually interesting because what the US administration did last year was actually trying to make sure that this did not happen, because they basically put tariffs on everyone, right? Because this was exactly, if I had shown you the graph from 2018-19, this would have been more extreme. But there is still some kind of rerouting going on, as we call it in economics. You can see TH is Thailand, so that's also something is going on. But if you look at Mexico, for example, that's MX, there's not that much increased exports from China to Mexico and from Mexico to the US, which is obviously something the Trump administration has been quite focused on. If you look at the chart to the right, that shows you in the red lines, that shows you basically what has been the change in US import share from China from 2024 to 25. So you can see what is, and that's a negative number if you look at the red. So that's basically a lot of actually high-end manufacturing, which is a big change to what happened in 18 and 19. Now it's high-end manufacturing, which is clearly where there's a lot less exports going from China to the US directly. And you can see on the other axis that some of these is actually going now, so there is actually an increased import share from the US through Vietnam, right? So if you, for example, look at telephones, computers, so there seems to be something going on from China exporting to Vietnam, then exporting to the US. So these are, of course, creating these fragmentation, right? Because it's something which is happening below this theme of the tariffs. And how should we try to put it a bit into a European perspective? So I think what I show you here in the chart here is in the left chart, it basically shows you how US trade with the US. And in the right, and it's an index number, so don't think it's just if it goes up, it is increased, if it goes down, it falls. And in the chart to the right, it's basically Europe's trade with China. So what it shows is that EU is actually importing more and more from the US, starting to export less, which after the tariffs came into place, it seems to have had some impact. And then I think China is a big one out there, right? You can see China's exports to EU has increased very rapidly. It had a dip, but now it's increasing very rapidly again. And EU's export to China is much, much slower. And I think it is a challenge. I mean, I have been based in Asia 7-8 years of my career during the 2000s and the 2010s. And I've seen that machine in China, that's industrial capacity they have. And this is something Europe, I think, needs to think carefully about. And it's, of course, a fine balance because we also want to, I guess, be actually one of those who actually focus on the rule of law and WTO compliance and so forth. But there is just a lot of, and you can say to some extent, unfair competition coming from China because we know that many of their sectors are quite heavily subsidized. And that's why when Macron is now leading the G7, he talks about what he called global imbalances, which I'm going to come back to later. So this was one theme I want to talk to you about. That was basically this trade, which is, so you can say what is going on is that when the Trump administration puts tariff on the US, it means that, on China, and China has this huge export capacity, it means that those goods are going to go elsewhere. They are not going to stop exporting. And what is happening now is it goes to Southeast Asia, it's going to Africa, and it's going to Europe, right? So that's unless they change their growth model, then that is what we are facing. A second theme I want to talk about is basically inflation. I wrote a book back when we had the big inflation spike in 22. So I guess the big question now is, given what is going on in the Middle East, can we expect something similar? Are we now facing a new period of inflation? So, and clearly this time the trigger is what is going on in the Middle East. It's coming from energy, it's coming from oil and gas. And let me provide you a few points on that. And that's obviously something at the central bank we are looking a lot into. If you look at the chart to the left, so when energy prices are rising, so what is going on now is that oil prices are rising, gas prices are rising. So that is what we call, you can say, wholesale prices. And then that trickles down into what consumers are facing. And what I show you to the left there in the chart is basically what has happened. So the war began basically 27th of February. And we now have 2 months of data. We have March data and we have April data. We don't have May data yet, of course. And you can see that it's basically the same everywhere. Euro area, US, and Denmark, you can see that consumer energy prices are rising. If you look at the chart to the right, that shows you also what we call energy price inflation. So exactly what is going on in terms of energy prices. That part is rising a lot. But of course, it's important to remember that people consume a lot of other things. So it may be that energy price inflation is rising to 10, 15, 20%, but that is not the inflation we are facing because it's only a small part of the inflation a normal consumer is facing. So how should we think about this? So economists as I am, we think of energy prices and the shock from energy prices having different legs. So it's first the immediate impact. So it's basically that you see your gas bill going up, or you see when you go and get gasoline for your car driving, you can see the prices have risen. But then there are a lot of other indirect effects, and that's what I'm going to talk a little bit about now. If you look at the chart to the left, that shows you what we call producer price indices. So that means that is the cost producers are facing. So think of if you are a transport company, or you are an airplane company, your cost of energy goes up. That means that so that's producer prices rising. Eventually, they may raise their prices. And there we can see, and I've tried to show you there in terms of how much it's increasing. we are clearly seeing that that is going up. How much that is then going to translate into that inflation is going to rise, the inflation we are facing, that depends on how strong our demand is, right? So can actually companies, despite that they face higher costs, can they raise their prices? That, of course, it depends on whether we are willing to pay it. Another indicator there, which we look closely at, and that was something we really saw in 21, 22, that was what we call global supply chain. You may remember that you heard about that after the pandemic. So there is some indices created around that, and that is actually also starting to tighten. So it does means rising. It does suggest that it's a little bit broader than energy. And that's something central banks like where I'm based, that is something we are watching very closely. Because if we become more broad-based, we are a little bit worried. Another thing we look at is the chart to the right, which basically shows you how many of, in what we call a consumer basket, how many of these indices are actually rising above the average. So if you see a lot of them, and of course be a limit, a lot of them rising a lot, that's a warning sign. If you look at the chart, and I've showed you there, US, Denmark, and Euro area, it's especially US where you start to actually see that many of them are rising quite a lot. But in general, we are not back at what we saw during 22. Let me go a little bit more into it. So we have tons of models in the central bank where we try to calculate this because we have a lot of data and try to say, how should we, if we look at our normal models, how should energy, oil price shock, which we have seen now, basically based on what we have seen now, how should that impact different segments? So these are these indirect effects I talked about. So not the gasoline you are paying when you drive your car, but more broader stuff. And there you can see that it takes some time, but you can especially see impact on transports. So that could be, for example, when you take a plane. You can also see it in food prices. You can also see it in even in restaurants and stuff like that. And that is what these are in levels term. So these are our estimates that if you transport, for example, based on the current oil price increase, that should increase by 2%, or 2% in terms of transport within the next 12 months, and a little bit less within 24 months. So these are the ballpark we are thinking about. But what I want to end you on this topic is basically, we don't think, even in a risk scenario where it prolongs and oil price gets higher, we don't think that we will get anywhere close to what we saw in 22. And that's, of course, the famous last word. But basically what I'm telling you is that inflation is not going to get 10%. And you can say that would also be a very bad outcome. So it's actually not much you're saying. But I would also say I think we'll be quite far away from that episode. And why is that? I think there's at least 4 reasons for that. First, in 22, you already had inflation when Russia invaded Ukraine, inflation rising beforehand. So there was other shocks coming through. And now we don't have that. If you look at what is happening now also, that the European gas and electricity situation is very different. It's much more of an oil shock, which is actually similar to what we saw in 22, but the gas shock is much smaller, which is really also what matters, especially for Europe. I would also say, you probably remember in 21, 22, interest rates were negative, right? Monetary policy, what we would call it, was accommodative. That's very different now. We actually have interest rate, at least they are positive. And so they are or not at least, we probably like that they are low, but so it's a different situation. And then the final thing, which I'm going to touch on, is that private consumption was much stronger coming out of COVID. So I think, and that's maybe something which related to all of this. What happened in 22 was not only Ukraine, Russia invaded Ukraine, it was also that we came out of COVID and we had so strong consumption, and it was such a special shock. And all this created that, you can say, perfect storm of high inflation. Let me go to my third topic, which I will talk about. And that's something which is a bit of a puzzle. And I have had 5 PhDs thinking about this for 3 months. And I think basically the answer, and I think I was cited for that in Weekendavisen, is still a mystery. We don't understand why Danes are consuming so little money. That may be strange. You probably feel you consume a lot of money. But given the wage increases people have seen over the last several years, There's something going on which is strange, that people are simply not consuming compared to what they normally would do. And it is maybe somewhat linked to some of the other things I talked about. So the fragmentation, the uncertainty, the risk of wars, the inflation spike, which was only 3 or 4 months, 4 years ago, is that what is making people worried? I can say we have not concluded yet. We have just say that we think it's a bit of a puzzle. But let me show you a few charts. The first thing is basically, if you look at the chart to the left, this is the change in the consumption ratio for the average Dane. So that is basically where you compare how much people consume compared to how much they earn. And that has dropped a lot. It's actually something like 8 percentage points. These are both pre-COVID, and I think we also have it compared to the 2010s. And you can see Denmark is actually at the end where it has dropped the most. That's not clear why that should be the case. US, they always consume, right? They even now have a positive, they have actually had a positive reaction in terms of consumption. So one explanation is clearly that you have had, so the chart I show you to the right is basically consumer confidence. So it shows you that confidence are pretty low, both in the euro area and Denmark. But again, why is that? Why is it when people are actually earning quite a lot of money that we are seeing this low consumption, low confidence, and thereby also consumption? And let me show you one more chart. This basically shows you where is it we have seen the drop. I'm 54, I'm in the middle. And I am, as you can see there, I'm probably consuming relatively normally. But you can see, especially it's the elderly. I don't know whether it's elderly, I'm soon in that range, but let's say above late 50s. And it's also the young. That's where you have seen the big fall. And I have tried to look to my people and said, is it because of rising inequality? No. It's not because it can explain a very little, because you can say if it was that the ones who are earning a lot of money are the rich ones, and they are not consuming so much of that they are earning, that could maybe explain something, but that cannot really explain it. So it's a bit of a puzzle, and one potential explanation for the elderly is that people work long and longer, so retirement age are really rising in Denmark, and maybe they are not really changing their consumption pattern. That's a potential explanation. Maybe some of the young people, at least if they are living close to Copenhagen, they are saving for buying an expensive apartment. That could be another explanation. But it doesn't really add up. So it's a little bit of a puzzle for us. It's a bit of a mystery, but it's something we are noting. And you can say somewhat worrying if these trends continue and with all the shocks we're having. I think I have 2 more themes I want to cover before I round up. And now I'm really going into a global theme. And of course, Denmark is also linked to this, so it's a slightly different. But let me try to, and it's something I have worked a lot on, but it's something which is a little bit, not technical, but it's really a global theme. So what does global imbalances mean? It means that some countries are spending a lot compared to how much they save. Some countries are running deficits, what we call current account deficits. And those countries who are doing that, and you can probably think about a big country, the US, they also need a lot of capital inflows. Other countries are doing the opposite. They are saving a lot compared to how much they spend. They are running surpluses and they are sending money abroad. That's actually also Denmark. But we are just so small, so we don't matter in the global debate around this. So what has happened over the last... So this was a big discussion before the global financial crisis. I need to explain you a little bit here. So what does this chart show you? It's basically in percentage of world GDP, what are the current account surpluses and deficit from different countries? And you can probably see in the red line, that's where you have the US. So US is always running deficits. They are always spending more than they save. The surpluses are always China, it's always Japan, typically also some of the oil exporting countries, but it's actually also increasingly Europe. It is still a big discussion among economists. Was this the reasons why we had the global financial crisis, or finanskrisen as we call it in Denmark? It's still debated. I think it had some impact that US was overspending and some was oversaving. You can say it's not necessarily a bad thing that some are saving and some are spending, but it is a bad thing if it creates distortions, if it's driven by distortions. And I'm kind of a little bit back to that. You can see that it's starting to rise a little bit, but it's not looking as bad as it did in 2007. So maybe that's a comforting thing. But not necessarily so, because you can think about that if you consume or you spend more than you save every year, it's like that you accumulate debt, right? It's like something you do every year, and then your debts just become bigger and bigger. If you think of it, these are basically global financial imbalance in terms of financial liabilities and financial assets. So again, the red one is the US. So net foreign debt for the US is just increasing. Because remember, they are running deficits, so they need capital to go into that country. If you look at the creditor countries, who are they? They are China, Japan, Europe. Right? And so again, is this a problem? It's a problem if it is led by distortive policies. And I would say it is to some extent, because in the US, they are running way too big fiscal deficits. You know, in the last couple of years, they have had a fiscal deficit of something like 6% of GDP, despite that they have a booming labor market, booming AI, whatever you name it. China is running massive surpluses, and it's driven by households. Chinese households are not spending. And this creates these things. So what is going on, and the reasons why we are interested from the Danish Central Bank is actually that in a miniature way, this is also going on in Denmark. We are saving a lot, and where we invest them in US stocks, right? We invest them in AI stocks. That is to some extent what is going on. And of course, it creates some risk. So the way we think about it is, and the way I think about it is that there is actually what I would call a bit of a private savings glut. So a lot of households, also companies across the world, both the US, even in US, but also in Asia and Europe, they are saving and they are investing in primarily risky assets in the US. It's a little bit of a simplification, but that's to some extent what is happening. And what does that mean? And this is something which is a little bit, for those of you who are into the finance part, these are something we look at if we look at what we call risk premia in different asset classes. These are showing it in equities. These are showing it in what we call corporate bonds, high yield corporate bonds. They are pretty low. And it may be, so again, why are we there? What we are arguing is that you have all these savings in the world, also from Denmark, but of course also more important for much bigger countries. And they are channeled into, you can say, risky investment in the US. Some would say, of course, that these, and we don't take a stance on that, this is because they're delivering so much return, but it is just investment going into the US. And at some stage, it's something to be aware of, that there is this, you can say, disharmony in terms of global imbalances and capital flows. I will end with AI. This is my final in my tour de force around global macro themes. So AI is I think it's extremely complicated to think about this from an economic point of view, because there's so many things we don't know. And I'm interested in it both from an economic point of view, but actually also because I'm part of the leadership team in the central bank, and I'm really pushing for also how much we roll it out in the organization, right? So I'm interested in it both from an economic point of view, but also like a manager point of view. Because I think it has so huge potential, because the central bank is a knowledge hub, right? And it's so that you should think that it should be able to help us. So I'm interested in it many different ways. I would also say I use it a lot myself when I think and write and so forth. Yeah. Let me try to give you a few economic perspectives. So the chart to the left here shows you the relationship on the x-axis. It shows you GDP per capita. On the y-axis, you have how much companies use AI, basically. And you can say this is well known, that the richer the countries are, the more they can use it. There is that clear tendency, and Denmark, as you can see, is pretty high up there. Where we are interested in it from the central bank perspective, I would say are different things. It's both a little bit what I talked about before, all the AI investments and the capital flows into the US. Also looking at it at trade, productivity gains, which I'm going to talk to you about just in a sec, because that's where we have done some work. Then we are increasingly doing work on thinking about the Danish labor market, or the European labor market. What are we seeing in terms of the labor market impact of AI? And then we are interested about it from the financial sector point of view. And there, it's also tricky, but we have not done so much work there yet. I mean, of course, we are very interested in also from the cyber risk perspective. But in terms of the financial stability risk, we need to do more work in that area. So how should we think about productivity gains in AI? It's a little bit anybody's guess, to be honest. The two last Nobel Prize winners in economics, Acemoglu, who won it in 2024, and Philippe Aghion, who won it last year together with a few others, they have so diverging views. So you have two Nobel Prize winners over the last 2 years in economics, and they are in one in each end. So I'll come back to that. So one way to think about it is to look at previous, you can say, huge technological or advances. So for example, the wave of electricity in Europe or the IT revolution in the US. And you can see it seems, these are labor productivity, it seems that there were clearly gains. If you look at the chart to the right, and that is, you have probably seen similar charts, but if you look at it, it seems that generative AI as a general purpose technology is actually becoming more widespread. ChatGPT was introduced in November 22 or something. It has moved quite fast. So could that make it faster? Who knows? So what does economists think about these things? What are the answer? How should we think of this? This is, if you look at the chart to the left, that basically shows you what economists think about what is the total factor productivity. And total factor productivity is basically not exactly the same as labor productivity. Total factor productivity is that you have a worker and you have some capital, and then how much added do you get in terms of productivity every year? So you cannot just have, if you just invest more, that does not get a total factor productivity. It's those two combined, and then how much do you get on top of that? And if you look at, see, there I have the name of Acemoglu, who won the Nobel Prize in Economics in 24. He's basically saying, not much. It's 0.1, 0.2 per year, percentage point. Aghion, who won the Nobel Prize last year, I think he's more like close to 1 percentage point. We have tried to go through all these models. I don't think we have a clear answer, but maybe one could think about some. I mean, one of the most cited papers is actually something where it's 0.4 percentage point per year. And that's quite a lot, because if you look at the chart to the right, and these are estimates for what we call total factor productivity. So the chart to the left, that's something which could happen for every year over the next 7-8 years. Chart to the right is basically showing you how much we have seen over the last, what has been the average total factor productivity. And if you imagine that the red line was just lifted by 0.4 per year, that's a lot. And I would say even it's 0.1, 0.2, 0.3, it's quite a lot. But so the stance we are taking is that we think there will be some productivity gains clearly from AI. But you know, the old famous economist Robert Solow, he said when we had the IT revolution, he basically said the only places where we cannot see productivity gains is in the productivity numbers. So everybody said that there was productivity gains, but we couldn't see it in the numbers. And it's a little bit the same now. Again, I think most economists, so for example, we see higher productivity growth in the US now. I think most economists are a bit skeptical that is really at a macro level driven by AI. But it should come. And I think I'm in the bullish camp. I think there will be an impact. So my conclusion, I took you a tour de force around different themes in the global economy. Hopefully it gave some inspiration. I think the overall conclusion is, of course, that the global economy is facing an extraordinary degree of uncertainty. I think there are clear downside risks to growth coming from this geoeconomic fragmentation and the war in the Middle East. But there's also clear upside risk coming from AI. And then there is this upside risk to inflation coming from the war in the Middle East. And then I think these global imbalances pose some financial risk, which I hopefully also got most of the conclusion on. So I think the way we see the global economy and the Danish economy now is that it's moderate growth. So despite all the shocks, and you can create a lot of tailwind and headwinds, I think at the end of the day, we have moderate growth in the global economy. We also think the Danish economy is looking quite healthy, close to 2% growth But of course, there is a lot of risk scenarios around that. I think I'll stop here.
That was really interesting. I think it's fair to say that there's a lot of uncertainties about everything.
Yes.
Everybody has their own opinion about, the direction of the economy, etc. We have time for questions, so this is a great opportunity if you have any type of questions to Thomas. Anybody in this room? There is a question down there. Can we get a mic?
Hi.
Oh, sorry. Over there.
Sorry.
Shoot.
My name is Eric. You talked about this geoeconomic fragmentation. Could you elaborate a bit on how we can see a future where more pension funds will invest in innovation in Europe compared to investing in the US? Thank you.
Good question. And also something we think a lot about. I can say that we actually on Thursday had a symposium on risk capital, which the central bank was chairing. So how do we create that? It's a little bit of a chicken and eggs, right? So I do think that yes, we should work on the savings and investment union. Yes, we should try to make sure that we create that environment where there's more money channeled into venture capital and so forth. But it's also important that we create growth in Europe. And that may mean that there's things we should adjust in terms of the single market and so forth. So I think it's a mixture of it. Basically what I'm saying is that I think there's a lot of things which has to fall into place to see it. I think you can say investors will still need to basically invest in what they think created the highest return. And there's a good reasons why they invested so much in the US, because the return has been higher. So I think it's a combination of trying to create the framework for being able to, that it's opportunistic for investors to invest in Europe. And then, of course, make sure that we continue to work on the single market in Europe, both in terms of goods and services, which will hopefully lead to higher growth in Europe. At least what I can say is that I think there's momentum in terms of talking about these things and something going on this front, which makes me hopeful.
I think we had another question down here.
Yes, I'm interested in hearing about why you left out the demographic development in the world, especially when we have increasing generations going from saving up to pensions and now starting to use that money instead. Wouldn't this lead to overall an inflationary environment where there's less money in the world, basically?
Good questions. And I could also have taken up the demographics, because you're completely right. It is a very important theme. So some is saying exactly your point, that eventually we are all getting old and then we will consume. And then you don't have that, you can say, excessive savings as we have now. But we are not seeing it, right? And you still have very, very large countries which are still in this transition phase where they are getting older. So you're right that theoretically one could think if we all were old, then we will start to spend. But I would say as we progress, and we have a lot of countries, also even emerging markets, large countries. I mean, of course, the obvious example is China, who have a high life expectancy, but are in this transition phase. So I would say the likes of China, the likes of Europe, the likes of the US are still in the transition phase where we are very far from being Japan, where they already are old. But it's a balance, so I agree, some of that could happen. I think it is still, I would still see demographic development in the US, in the world, supporting savings in the world, net.
Thank you. Any more questions from anybody? Now you have the opportunity to ask a real expert. No? Can I ask you?
Of course, Bo.
A question. So you speak about, all these blows. Do you have any idea about what is the next blow to expect? Anything you discuss at the central bank?
That's a good question, Bo. That's a very good question.
Thank you. As you can see, he didn't know about the question.
No, he didn't. Exactly. We had not coordinated. That's how it should be. No, I think what we focus on is more, you can say, as a central banker. I used to be in the private sector, and there it was, I'm not saying, at least where I was, in markets and so forth, it was a lot about trying to predict the future. I think I'm less in that game now. It's more about creating resilience. And that's the reason I don't really come up with a very good answer to your question. And that we are focusing on. So how can we build resilience from where we are present in the central bank? We are focusing on the economy, the fixed exchange rate, of course, financial stability, payment systems, where we really have the responsibility in Denmark. So I think we are more focusing on creating that resilience. So cyber risk and so forth, rather than trying to predict where it's going. We just take as an assumption that the world is very uncertain and there will be new shocks hitting us and Denmark. And that's where we're working from. So I don't have a very clear way I say this could be the next shock. But good question. I need to think more about it.
Can I have, there's a question down here? Yeah.
That sound, right, there we go. Good morning. No, my question relates to public expenses or public expenditure. Sorry. So, if in Europe public expenses increase for funding purposes, say military or otherwise, or infrastructure, what not be, if the expenditure within GDP is driven by the government, do you think that will put pressure upwards on inflation?
Yeah, good question. I mean, it depends on, it will not, I think, let me put it another way. It will not be the primary channel I will be most worried about. It is more that some European countries, think about, of course, some Southern European countries have very high debt levels. So it's more the financial contagion, potential financial contagion of that. You're right that, of course, if you, and it is something we're also watchful of in Denmark, where we are using a lot of that, more money on military and so forth, is that creating capacity pressure? In a Danish perspective, less so, because we import a lot of it. You're right, in some European countries where they produce or some of it, it could create some inflation. That's right. But again, it will not be my primarily worry. My primarily worry is that simply the debt levels are pretty high in Europe in some countries, and therefore they simply don't have much capacity.
I think we'll end it here. Thank you so much, Thomas. A big round of applause again. Really, really great inspiration. Thank you so much. And it actually also means that it's time for the first break. I think there's a lot of things to discuss from the presentation we just saw. So get out there, network, grab a coffee at the barista station in the networking area, visit the innovation booth and speak to our experienced experts. And last but not least, get your Lead the Future avatar. It takes 2 minutes, AI generated, and it's really, really fun, and you can bring it home. And I'll see you back in here, 11 o'clock. Thank you so much.